Thanks for tuning in. Now, time for part two. This is the first time that the long Canadian productivity boom that's been well talked about maybe starting to inflect. And how do you maintain that momentum? What needs to be done more? Let's say you were the Canadian PM. What is your wish list for like two or three things?
Like, I think it's the start for sure, and to maintain momentum, you have to execute, and execution, often involves partnership, and I think that's one thing we're hearing more from the current federal government is that they're bringing in more people from industry, and they are going to try and work together with the provincial premiers and leaders to tackle issues together, and there are important issues that need to be addressed, particularly around housing and healthcare delivery. But there's no reason why they can't be working together more effectively and to deliver those things. So yeah, like I'm optimistic that we're going to start moving in the right direction, and we yeah like the speed of some of the initial cuts to like resolving the capital gains tax and the carbon tax, like they took those off the table fairly quickly. So there's no reason to think they won't make some good progress through the balance of the year and maybe in 2026 as well.
Damien, if you were the Canadian PM for a year, what would be your first couple of things that you think could really accelerate going forward?
The wishful thinking. There's if I could be the Canadian, if I could be the Canadian PM for a year. The look, the last few years, GDP growth is population growth multiplied by labor productivity. How right? Like economics 101, GDP growth is population multiplied by how much those people are producing. And so the last few years we've had population growth. We've actually had, but that second variable, productivity of the labor force has actually been declining. I think if I was if I'm sitting right now, in a leadership position, and I don't mean don't mean at the prime minister, but even the provincial, like the premiers and stuff, I would be. We've had the population growth. We need to channel that population growth into more productivity to actually lift this up. And so I would be focusing on, training efforts to improve our current workforce to deal with this. I'd be focusing on removing barriers to that. I would be focusing on just like on removing, for example, James was talking about, we're both in Toronto, they like just removing institutional like barriers to red tape to improve that product, because I think that will help us get to that, to a higher sustaining level
Because we have all the inputs, right? We have the land, we have the resources. It's like the rest, the ingredients, the high quality Michelin star ingredients are there. It's the dish is pretty
well,
lukewarm, you know.
just the but there's even there though, at the margin, right? Like we're at an inflection point. Like like Kitimat is just being built, and like they're going to start. This is out in BC, the LNG thing. They're going to very soon in the next few weeks. They're going to actually have their first shipment. They're talking about expanding that, exporting LNG. Like I think at the margin there is a change that people haven't fully accepted. Like the housing market of this country isn't collapsing, right?
Yeah.
Like
That was a big worry for the
that's a
last
big
few
worry for the
years.
last few years. It's not like, the population growth we've enjoyed is slowly being absorbed. If we get them into more productive roles and improve productivity, I could actually see, you could paint a picture, and James talked about this. Starting sentiment and valuation is like valuation's attractive, and sentiment, like, no, I don't think most people know the TSX is up high single digits, double digits, right?
Or breaking out to new all-time
No,
highs.
breaking out to new, exactly.
TSX keeps breaking out new all-time highs, and it's like BNN or no one seems to stealth rally, right?
Those are ingredients of outperformance, and I'm saying this from being a global PM. And you look at the TSX, it looks like one of the best performing markets technically. Like we just broke out to new highs, and 26,000 looks like support now, and it looks like we're moving higher from here.
To expand on that just for a second, so what's really interesting to me about it is that it's not some of the sort of set it and forget it traditional Canadian sectors that are leading. What's not leading right now is banks, railroads, and energy. On an absolute level, some of those parts of the market are doing really well, but they're not leading the market higher. What is leading is insurance and gold, and to some extent, food retail. These are different parts of the market that maybe don't typically get quite as much attention, and it's a little more Canadian, sort of as a Canadian manager, it's Canada specific, but these are things that we've noticed as managers, and what we're trying to make sure we're avoiding, is that some of the stocks that have idiosyncratic problems in the traditional parts of the market that aren't being priced accordingly or might not resolve soon. Like, we're trying to make sure we don't own too many of those. And we have noticed that there are these other parts of the market that are moving higher. And so we want to understand why that is, and if the trends are sustainable, and if there are companies that have competitive advantages that we can come along for the ride with.
Just think about that for a second, right? Just to build on James, oil's at $62.
And the
Right.
Canadian stock market
Is
is
that
all-time
breaking out to
highs.
new all-time highs?
Yeah, which
Like,
is a great sign, right?
And imagine if like oil just stops falling, right? Or actually goes to 65, 70, and Canadian oil and gas is a big part of the TSX. If that stops declining, like you could actually see, the ingredients are in place for, I don't even know, Jose, what but I feel like this podcast is like a Go Canada on the day of like the Stanley Cup where we have a team.
I was gonna put a rapid fire question at the end anyway, but like now that I have you here, your predictions, because we have two Canadian representatives, SGA, let's just say the MVP for basketball championship. Are we doing a Canadian sweep in basketball and hockey?
We're definitely overachieving in sports and in equity markets. So so far.
That is the right way to describe it.
Obviously my biases are like I threw the Leafs jersey in the bonfire. And
Are you behind McJesus now?
I think Connor is, but I think they're a better team, so I'm hopeful. And I think as you're seeing in equity markets, I think there's underlying resilience here. There's some actually really good things, and I think that actually dovetails nicely if we're just, into what the Oilers can do, or even what SGA has been able to achieve for a team that people at the start didn't think would make it to the NBA Finals.
Kind of very much in parallel with our stock market, if you actually think about it. So that's a great segue to the other side of the border. Now we discussed Canadian politics. We've seen Canadian stock market, very encouraging. On the other side of the border too, I would say policy has been chaotic, to say the least. But it does feel like the last few weeks have been a little calmer. Do you sense a shift over there where there are calmer heads in the room driving the decision making, the messaging better, post the Liberation Day chaos? What are your thoughts on what's going on in the U.S. policy wise? And we'll dive into the other topics as well.
I'm curious to hear James' thing, because James is an observer for what's happening in the U.S. market. But I'll start with this, and I think this is, like, if there's lots of things I hope people take away from this podcast, but one thing I really want people to take, because there's academic evidence about this right now, is that, how do I say this? People are crappier online. Or they're like, you look at the comment section in your Instagram feed, people are just like I can't, like, people are just crappier online, we're meaner online, use whichever adjective you want that's a lot more coarse than crappier. But why am I saying this? It's because when you look at the sentiment, the soft data numbers, in whether it's, we just like consumer confidence, or like people are expecting Armageddon after, Liberation Day, and we just had Q1 earnings, and and what's happened since, and we had the JOLTS number, job openings by industry. That's stopped declining. That's making new highs. We're gonna have the non-farm payrolls in a few days. Like, the U.S. economy is doing just fine. It's slowing from, from actually, like, what I'll call, from really, like, in a good way. It was overheating. So we're slowing from, peak levels, but we're nowhere even close. Like, we're still growing above trend. And I think what's happened, right, is that, to get to my point, is that when you ask people questions, and this is what I was talking about, academic evidence supporting this, before, when you had surveys, people actually went door to door, asked people, called people up on the phone, asked them how they're feeling. Now, a lot of surveys are digital. You get a link in your inbox, you send, and you almost have like free reign to be a crappier person, or be much more like
not as thoughtful, not
as thoughtful,
yeah.
and so what you're finding is that the sentiment is underperforming the actuals, right? The reality is much better than how people feel. Like, if you told me in the US, one of the biggest online on this, right? We talk, like, people's views of inflation, both actual inflation and, for the most important components, expected, are like, they're like, oh my God, inflation is significantly high. It's going to keep getting higher. Inflation is falling. The
And
biggest
even then, you showed me something where there's a bifurcation.
yeah, there's
right?
bifurcation between,
Yeah.
but like inflation's falling. We can talk about that. That's funny. But inflation's falling. But more importantly, for the regular, middle class, higher income, like American or even lower, the biggest variable in their perception of inflation is the price of gas. Gas prices, to our point, like WTI is $60, like, or like to fill your gallon, like it's like everyone's you go fill up your tank. It's gotten so people's perception in like versus reality. People are like, oh my God, inflation's is really high and it's going to keep increasing versus reality. It's falling and it's going to keep falling. And the biggest variable that you
This
see,
disconnect has been there for a
Yeah.
while now.
and I think that continues for our team, that continues to be exploitable, where whether it's what we did post Liberation Day or just, exploiting this panic that is being amplified through social media channels that when, and a complete, almost like ignoring what's happening on the ground, like the actual, like, hard facts.
James, you've been observing, but no one can ignore the U.S. market, and of course, the U.S. market policy has a lot of implications for Canada, right? So, what are your thoughts of just the chaos, and since then the recovery and messaging? Yeah.
Yeah, so I think there's been a change of tactics. You can see how the market has been recovering in the last couple months, and we've been seeing a lot more and hearing a lot more from Treasury Secretary Scott Bessent, and Peter Navarro's off in a corner somewhere talking to himself or whatever. So I think that's a change in tactics, and I have to admit I've watched and listened to a number of the long form interviews, and it gives investors, I think, more confidence that there's actually some method to the madness, or at least a willingness to uh, change tune or adapt, because
Take
that's
feedback from the market, basically, right?
it's exactly. I think that's an encouraging sign. What I've been watching for from the sort of the Canadian income world has been the budget deficits. I think this is really important, and it's also quite fascinating. Like, if you think back to the 80s, 90s, 2000s, budget deficit in the U.S. was like 2% of GDP, which was meaningful, but in hindsight, not that high. It sort of doubled to the 4 to 5% range in the 2010s. And I think last time I checked the numbers, it's been running at 8%, 7-8% in the 2020s so far.
In a non-war, non-disaster situation,
Non-recessionary, non-war, yeah.
non-recessionary, yeah.
This is like a significant change, and it's, I think, underappreciated, and it's putting this upward pressure on the long end of bond markets. And it's really important for me and the number of portfolios that I manage, because we have so many income oriented stocks. So I'm paying attention to that, and I'm hoping that they're able to thread the needle of, okay, they want to do these trade deals, that'd be good. They want to cut taxes, that'd be good, but they also have to deliver some of those Doge related spending cuts. Otherwise, the bond market at some point is going to start rejecting these like massive deficits, and that's sort of what I've got my eye on.
So I love that you brought that up. Let's unpack that a little. So U.S. equities have made a resurgence. So the spike in yields have not really yet worked that way to the equity market. At the same time, let's say the spread between the 30 and the 10 is also widening, like the term premium is widening. So my question is this a sign that the bond market is pricing in some sort of growth and inflation, both sides, where the policies are actually really pro-growth? Or is it the risk of the deficit widening? Which element is playing more? Or what's the thought process there?
I think the deficits need to be priced. And if things are really going to get shaky, then that steepening of the yield curve will advance more quickly than people expect and more than people want. So I do think they have to be careful. The key is to have the growth and the inflation imbalance. And I think one of the plans that I've heard is this so-called 3-3-3 plan.
Yeah, that's been making the
Bessent
rounds.
wants to hit that 3% inflation, 3% GDP growth, 3% budget deficit. So if they can bring these factors into sync and not allow one part of the agenda or one part of the puzzle to really get out of sync, I think it can work. And the equity markets are hopeful for that outcome in the next 12 to 24 months. That's seems to me what's being priced in or what's being hoped for. And And I think the administration kind of has to steer the boat in that direction.
Damien, your thoughts here, like has also just broader picture globally, just adding on to that. Yeah, I want your comments there, but like, has the nature of fixed income investing changed in general? That's the
Well,
extension.
I think fixed income is getting back to what our fixed income colleagues will say, which is like you buy fixed income for, it's in the word, income, right? So before, like the people were buying fixed income for capital gains because they watch bond yields go from 5 down to like 50 basis points. Like that's not like you buy fixed income for income. And right now, fixed income yields in the 10-year treasury sitting around 4.4, 4.5%. That actually feels normal. And let's break this down, right? Like what is your fixed income yield composed of? It's composed of real growth, expectations for inflation over that horizon, and the term premium. The term premium is just your compensation for being wrong, right? And so real growth, let's call it 1.5%, right? 1.5%, 2%. Inflation, like over the medium term, likely headed back to 2% or a little more. So you get to around 4%. Well, what people have to get to terms with is what's the right term premium. And the term premium, it really addresses what, both James and you have just been talking about, which is how comfortable are people that the deficit will start normalizing to a more sustainable level. And if I talk about that for a second, right, people are rightly panicking about the deficit, but we're at the same level we were last year. The actual platform being proposed, it's sitting right now with the Senate in terms of the new budget, it keeps the deficit at the same level it was last year, which is still insane, right? They're like technical term insane, minus 6% of deficit. You can like that. Like the deficit is how much you're borrowing divided by GDP. You can actually run a minus 3% deficit. Your deficit can be 3%. And if you're doing 2% nominal growth and 2% inflation, by definition, your leverage ratio is falling, right? And that's what Scott Besson's been talking about. So I think we have to see a pathway for getting the deficit from these, like eye-watering levels of -6, where you are now crowding out, like where interest payments are now higher than defense spending, right? Where interest payments are now slowly crowding out non-discretionary spend. You have to get that lower. And the problem is, and this is the cynic in me, politicians will do the right thing, but just when forced, whether it's the Democrats or the Republicans, they will address government spending, but it's not going to be organic. It's not going to be, and especially under this current administration, it's not going to be, hey, let's wake up and talk about, the deficit hawks. They might have something here that we should probably, like, it's not happening organically. It will be a tantrum that in the bond market that forces their hand.
So probably, well, what's that number? Yields go to 5-6%.
Well, I think, we
like
know.
5.5, 6.
5 seems to be the line in the
5,
sand.
yeah.
But it could be higher, but that's the line in the
That's the
sand
line,
for now,
right,
I think,
in
on the
some
10-year. Yeah.
Yeah, I think 5%, though, you'll have unintended consequences where something will break. A lot of the financing takes place, like things that people forget, right? At 5% 10-year yields, like even just, lines of credit and stuff, or overnight, but issuing lines or commercial paper gets expensive. That starts gumming up like the plumbing of the economy.
plumbing of the economy.
So yeah, I think that will force their hand.